On Friday night, S&P Global booted 3 stocks from the S&P 500 and replaced them with 3 newcomers that better represent the current economy. They brought in CrowdStrike, the Cramer fave cybersecurity play. We had them on the show last week, along with KKR, the private equity pioneer, and GoDaddy, the website builder and digital marketing firm. That's why all 3 stocks jumped like they did today, because everybody knows the index funds will be forced to buy them when the change becomes official 2 weeks from now. No kidding. You know what? I want to do something different. I want to twist things around. I'm going to focus on the 3 stocks that got cut from the S&P 500. See if they're worth buying. Comerica, a suboptimal regional bank. Illumina, a DNA sequencing / diagnostics company. And Robert Half, a staffing and human resources consulting firm. I'm wondering what happens to these exile companies aside from the initial wave before selling. Is there any hope for these companies, or are they basically doomed for the foreseeable future? If history's any guide, the answer is a little depressing. The answer is nothing good happens to them. All right, but I'm going to be scientific about this. Not going to be just seat of the pants. Let's take a look at the recent exposures for the S&P 500, because I want you to know how they performed. The last 2 stocks to get the boot were VF Corp, the troubled apparel play, and Dentsply Sirona, and that's a dental supplies company. And that happened early in April. So far, both stocks have continued to go lower since the initial announcement. VF Corp's fallen almost 13%, and Dentsply Sirona is off almost 19%. Meanwhile, the index they got kicked out of, it's rallying more than 2% over the same period. VF Corp's decline was actually worse than that for most of April and May, before the stock started showing signs of life in recent weeks. The company's reported yet another very bad quarter on May 22nd, and its stock has fell to a 52-week low of $11 the next day. But then it rebounded going into the close, and since then, it's acted a little better, climbing to $13 and change as bottom fishers started coming in. Betting the worst must be over. Look, anything's possible. I like Bracken Darrell, the new CEO, late of Logitech. This one is a tall order even for, say, Hercules. As for Dentsply Sirona, that one's been pretty much straight down since the news, including a 6% single-day decline after reporting a not-so-hot quarter in early May. Okay, let's go back further. On March 18th, Supermicro and Deckers Outdoor joined the S&P 500, and in order to make room for them, the index dumped Whirlpool, yes, Whirlpool, and Zions Bancorp, which is another troubled regional bank. When you look at the performance since the announcement on March 1st, these two are a mixed bag. Whirlpool's beset by lackluster home building environment and a consumer that's less willing to shell out for big-ticket items. So its stock has fallen more than 17%. But Zions Bank actually held up a little better. Stock's up more than 6.5% since the announcement, actually outperforming the 4.4% gain for the S&P 500 during the same period. But that's not anything really company-specific. See, it's just that Zions got hit insanely hard during last year's mini banking crisis, and the stock's gradually been recovering ever since we realized that a bank run was off the table. Sure, it's not doing great, but it's not doing terribly either. Certainly not to the point where we're worried it might go under. So, of the 4 stocks that have been dropped in the S&P 500 so far this year, 3 have underperformed significantly in all cases since the announcement, while just one, Zions Bancorp, has outperformed in the time since it got the pink slip. You know what? We also went back and looked at the 10 stocks that got kicked out of the S&P last year and still exist today, and you can see the same trends. Specifically, of those 10 stocks, only one has outperformed the index, and that's Lincoln National. It's a major insurance company, the Link, Philadelphia, where the Eagles play. Makes sense since they're in an insurance bull market, and we heard that from Chubb last week, right? The other 9 have lagged the S&P, some a lot more than others. For example, packaging company Sealed Air is up more than 13% since we learned about its dishonorable discharge last December. Not bad at all, right? But not as good as the S&P. It's up almost 17% gain over the same period. Hey, same deal with Organon. That's the drug company that's all about women's health and off-patent medicines. It's up nearly 20% since its dismissal from the S&P was announced last October. That's a fine performance, except the S&P's got a 24% gain over the same period. Of course, there are also some huge declines here. Of last year's 10 explosions, 5 are flat out down since we learned they were being removed, even as the S&P was up double digits versus every single one of them. Lumen Technologies, debt-laden communications company formerly known as CenturyLink, oh, man, lost 60% of its value. Solar Edge, the struggling residential solar play, it's down more than 43% since we found out it was being excommunicated. Newell Brands, yeah, remember the old Newell Rubbermaid? Dropped 30% since the announcement. Wow, that's awful. And by the way, this analysis excludes the 4 other stocks that got kicked out of the S&P 500 last year. 3 of those were regional banks that got seized by the FDIC in order to prevent bank runs, while the 4th was Dish Network, which got acquired by EchoStar at the end of last year. But Dish Network stock was at $7.30 when we learned it was a goner. And when you look at the EchoStar shares you would have gotten in the takeover, well, they're only worth $6.26. So down 14% during the period when the S&P's up more than 25%. What a list we produced here. Now, why go through this whole exercise? Because when I saw the companies being expelled from the S&P last Friday night, Comerica, Illumina, Robert Half, my first thought was, hey, they're not that bad. Comerica's a decent enough regional bank, which happened to position itself poorly for the Fed's rapid rate hikes. But it'll be fine if rates come down later this year. Illumina had all sorts of trouble in the post-COVID era, but much of its management's been replaced over the past year. And last week, the stock jumped when we learned that they're spinning off their Grail cancer testing business later this month. Feels like it could be approaching a bottom. As for Robert Half, the staffing firm suffered from softer hiring trends in some of the most important end markets like tech. But it's still a company with a pretty good long-term track record. However, when you look at how these former S&P 500 components tend to perform, it's hard to get behind any of the new ones. Sure, removal from the S&P is not a death sentence, but the numbers here are stark, aren't they? Of the last 14 names that have been removed from the index and still exist today, dating back to the beginning of last year, only 2 have outperformed the S&P since the announcement. Bad odds. Don't forget, people talk about buying an index as passive investing, but the S&P 500 is more actively managed than people realize. The team at S&P Global does a fantastic job of deciding which stocks to add and which stocks to subtract. That's one of the reasons why I'm so comfortable with telling you to put a big slug of your savings in an index fund that mirrors the S&P. There's nothing passive about kicking out the weak and adding the strong. The bottom line, when you see a stock that gets expelled from the S&P 500, please don't bother to try to catch a bottom. You're most likely catching a falling knife. Historically, the odds are very much against you. If Standard & Poor's doesn't want them, well, you probably shouldn't want them either. Mad Money's back after the break.
Coming up, new healthcare names to consider. Cramer reveals a few healthier choices. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.